Well, the Fed, for the last year, a little more, has been shrinking their balance sheet, which had the effect of shrinking banking deposits. So the market was getting tight. We saw this all of this year. We saw it in December in spades. And so there's been a lot of discussion inside the Fed for well over a year about complementing the shrinkage of the balance sheet with a program that would let them put liquidity into the market when needed. But they haven't acted on it. They're at least a year late. You know, Dudley Williams at the Fed of New York are wrong when they say they didn't miss this, or when they say they didn't miss this. So what I think it's key for investors and also the public at large is the Fed really serious about the target for Fed funds at 1 3/4 to 2? Because if they are, they got to defend that 2% upper bound. They have to be ready to add enough cash, not reserves, but cash, to make that market clear. And even today, we had a very brisk trade this morning.
Yeah.
They could have done more.
I guess, Josh Brown, we hear that a Federal Reserve Bank, arguably the most important, New York, has effectively a cash shortage in some ways, and it's getting fed in by the Federal Reserve macro. But we haven't seen the market move on this. Why do you think?
Because there's a completely rational explanation for why there might be a mismatch and how much liquidity is available from a Monday to a Tuesday. And I'd love to ask you, Chris, what your thoughts are. This is 6 years ago. We had something very similar, but it happened in China with Shibor, the Shanghai Interbank. And we were told that that would presage a crash, not a recession, not a correction, a crash, not only for China, but for the entire Asian region and anyone that does business with China and anyone who relies on funding from anything related to China. And actually, the whole thing blew over in 2 weeks. The Chinese authorities figured out, OK, there's more liquidity needed, and there's a little bit more clarity on what the rate will be, and we'll just get all the banks to calm down. Now, that's a little bit more centrally planned than we are here. So I understand it's apples and oranges, but isn't it more reasonable to say, OK, the Fed has identified something that they are causing and they should fix it, and then we can all get on with our lives?
Well, I think that's right. But remember, when they departed and started buying trillions of dollars worth of securities, they created this super asset called reserves, excess reserves that don't have to be hedged, and they trade at par every day. So banks tended to want to hold those and not treasuries and agencies. They distorted the market. So now that we've been reducing the balance sheet, the Fed hasn't realized until today or last week that they needed to manage liquidity. When you're brutally reducing the amount of bank deposits, which is what we're talking about, every time one of those reserves got redeemed at the Fed, the Treasury had to go.
What would you prefer? What would you prefer the fix be? A standing? Yes. Here's the rate, yes. Or stop paying so much on reserves, which, frankly, I think is slowing down the velocity of money. I don't know why they're paying on reserves at all.
But
frankly,
the Fed has to realize that they need to manage volume of liquidity versus whatever their price target is. If they say the upper bound is 2, they got to defend 2. And this morning we were trading over 2 for GCF.
They came in twice. I mean, overnight and term.
Yeah, but this is a medium-term problem. Yeah. If they don't commit to the street before October 5th, which is their current guidance, that they're going to continue this through the end of the year, then we could repeat last December.